Hello, welcome back to another video. So in today's video, I'll be covering two main portions. I'll be covering compounders falling as well as my response to the comment section after my Google sale. So for reference, this is my entire portfolio. I update this weekly. So Google is still currently my largest position in my entire portfolio, and I'll be covering the Google section later in this video. So first of all, let's talk about quality compounders first. I'll keep this one as short as possible. So first company that I'll be covering is Copart. Copart is down around 13% year to date. So for Copart, here are some of the potential catalysts for the company. First of all is that your management is sitting on a lot of cash right now. So they currently have around 10% of their entire market cap in cash. So if they're able to deploy that cash soundly, if they're able to deploy that cash to return to shareholders through buybacks, which is what the management has said in the last earnings call, and we could see a resurgence in terms of the EPS growth of the company. And if you were to look at Copart's history with buybacks, all these different buyback periods can serve as catalysts for the stock price as well. So this is one potential thesis that could play out for the company. The second one is simply just the cost-cutting efforts. So Copart in their last earnings quarter actually grew revenues by only around 5%, but their net profit as well as their operating profit went up by double-digit, mid-teens as well. So for Copart, this signals that the company is able to maintain or even expand its margins, which is extremely healthy for any given business, and even better for a company like Copart. Next company that I'll be covering as well is TransDigm. So TransDigm is down around 20% since the peak already. It is currently trading at a 42 times of earnings, and it is up around 1% year to date. TransDigm is basically a company that buys a lot of different small aerospace companies. So for example, in your commercial aeroplanes, you have all those small parts like your seat belts and so on. What TransDigm does is they will buy all these companies, they will hike prices, they will hold patents, and then they'll grow their earnings along the way as well. It's a very simple business model with leverage, and they are the best in class. So it is unethical, but if you were to look at the price increases for TransDigm, it's been incredible. They've been able to hike prices by thousands and thousands of percentages, which is what is leading to incredible growth for the company. So if you're unfamiliar with the aerospace industry, TransDigm is actually a big player in this entire space. So for example, a seatbelt like this has to go through many phases of regulations, as well as patent approvals and safety approvals. So for TransDigm, this is the moat for the company. The moat of the business is simply just the high barriers to entry and the high switching costs for all these different companies, as well as recurring revenues coming into the company. So for example, a seatbelt like this has an expiry attached to it, meaning to say your commercial airplanes will have to change it after a certain period of time, and that is recurring revenue for the company because all these different companies, they'll have to get it replaced, and the only way for them to get them is through TransDigm. So that's the beauty of your aerospace industry. And I'm also looking at another company as well, which is Honeywell. It's a company that is undergoing some form of change, and I'll be updating soon if I find the company interesting. The next company that I'll be covering as well is FICO. So FICO is down around 23% year to date, and this is my updated thesis for the company. So first of all, the FHFA actions were overblown. So if you saw what happened with Bill Putte as well as FICO just a few months ago, Bill Putte came out and said that your Vantage score will also be allowed in your loan origination portion when it comes to Freddie Mae as well as Fannie Mae. But despite that, the CEO has actually came out and said that FICO hasn't seen any form of market share loss, and this is because there's no reasons for your lenders to switch. So lenders, they don't want to take on more risk, they don't want to take on more unwanted risk, and all the price increases by FICO is simply passed on to the consumer, so there's no reason for them to switch anyway. Besides that, FICO will be able to maintain its strong pricing power, something that was feared by the markets. So FICO has been increasing prices by upwards of 40% over the past few years, and I expect this pricing power to continue on for a very long time because your FHFA, they lack the ability to limit FICO's ability to increase prices. So FICO provides mission critical scores that is a very small portion of the entire loan origination system. So for FICO, there's no reason for anyone to switch away from them, which is why I'm confident that the company will be able to maintain its pricing power. Besides that, FICO's software business is also a portion that is neglected by the markets today. So besides having their FICO score, they also have the FICO platform, they have the Falcon software as well. And if you're to look into the software portion of the business, around 61% of the entire software portion is still on-premise. So on-premise means that they have to go down to their client's location, they have to build out the infrastructure there, they have to build out the software infrastructure there, instead of building it out on the cloud. So currently now the company is doing something similar to Equifax. They're trying to transition most of those on-premise portion to on the cloud. And what this will help to do, what this will enable FICO to do, is to expand their margins and bring in recurring revenue every single quarter. So this will increase the lifetime value for the customers using FICO, and overall this is bullish for the company. So for FICO and the valuation as well, if you are to do a DCF calculation, I would say the fair value is currently around $1,500 a share. So the company at its current price at a 60 times of earnings is around fair value. So for FICO, that was why I initiated my position at around $1,350 a share. The company was undervalued at that price, and hopefully the company falls a lot more so that I can add to my position. Next portion, I'll be covering my investment philosophy, and this is in response to the Google comments that were made after I trimmed my position. So my investing approach is to invest in exceedingly high quality businesses that are predictable, that will compound earnings for many, many years to come, with some catalysts in place as well. So that's why I avoid companies that are in fashion, that are in apparel, that are in airlines, and restaurant brands as well, because all these different companies, they operate in highly competitive spaces. And although some bad stocks can make good investments, that is normally the approach that I avoid. I don't like investing in bad companies that could potentially be good investments. So here are some comments that were made after my Google post. So I posted that I trimmed my Google position by around 15%. And so here are some of the comments here. It says, trim your winners and double down on your losers, lol. Why would anyone trim Google right now? It's only just getting started. Google just surged to 200 plus levels and you are already trimming. I think Google is going to $300 easily. Why not wait a little longer? So all these comments here are not wrong, but let me explain my stance a bit. So this was why I actually removed my Meta position just around a month ago. So the capex spend by all these Mac 7 companies is incredibly high. So Tim Cook and Mark Zuckerberg actually came out and said that they'll be spending $600 billion on AI infrastructure on capex over the next few years. Satya also came out and said that he'll be spending $75 to $80 billion every single year on capex. So one could argue that this is the mode of the company, basically the ability to spend so much money on infrastructure, but it definitely feels bubbly as well. So here are some napkin numbers for a capex spend. So this is from Meta 10K. So they said that the servers and network assets have a lifetime value of around 4 to 5 years. So let's do some capex calculation here. So for Meta, this is the entire capex that is being forecasted. So they're forecasting around $100 billion of capex next year. So let's assume that the capex spend is basically maintaining all the way until 2030. So if you were to look at Meta's numbers, so currently the company has around 5.1% of their entire revenue under depreciation as well as amortization. So if this capex continues all the way until 2030, as you can see here, the numbers will double in a few years, and it will make up to around 13% of the company, assuming that the revenue growth is at 20%. So revenue growth of 20% is already quite drastic. So for this company here, as well as all your different other Mac 7 companies, there are definitely risks associated with the capex spend. If they're spending money irresponsibly, then this could turn out very wrong. And that's why I'm getting cautious with all these different Mac 7 companies. So for Google, I'm bullish on the company, but there are a few things to take note of. So first of all is that the stock is up and suddenly the stock is becoming the best company in the entire world. So if you have to compare the sentiments when the stock was at $160 a share, as compared to currently when it's at $230 a share, nothing has changed fundamentally. The stock is still the same stock, and yet now people are getting a lot more bullish with the company. The truth is that Google's moat is weaker today in search as compared to a few years ago. I'm not talking about Google's other businesses, but primarily in search, the company is definitely weaker as compared to when it had no competition. So Google's other portion will more than make up for search deterioration, but to say that the stock is unstoppable after a 50% rise in the stock price is probably a bit far-fetched. I think Google long-term will still do very well, and that's why I still have a substantial portion in Google. But I think trimming to account for risk is probably the right thing to do in this scenario here. So this was what Chris Hohn actually said about Google just a few months ago when it was at around $160 a share. I think most people forget about this one.
What about the other tech companies?
We have a position in Alphabet, and which is maybe our most risky investment, where they're clearly the company, and it's just one of our smallest investments as a result. And where we have some level of protection because there are businesses like YouTube and their cloud business, which represent half the market cap today, and their cash and other things. So it isn't all search, but search is critical. And so can they out innovate competition? Yeah, there's a risk of search fragmenting, as competitors come in and try to, but it's a question mark. Yeah, we don't think so. We think they have a lot of advantages of their data to have to offer higher quality search results, and but competition is increasing.
Talking of which, how do you think AI will change the investment landscape?
Yep, so like what Chris Hon said just a few months ago, I think most people have forgotten about this one. Google search is currently facing competition for the first time in many years, although the fears were probably overblown at around $160 a share. If you're buying Google stock today, your margin of safety is probably a lot lower. So like what Chris Hon said over here just a few months ago, Google is a risky stock. Google is his current riskiest position in his entire portfolio. So I think a lot of people have forgotten about this just because the stock has run up by 50%. But I think at $230 a share today, company is probably a bit overvalued, and that's why I trim my position. The next portion, I'll be covering some questions left in the comments. So the first one, it says utilities may be a good bet in this kind of market. What do you think about waste management companies right now? Like waste management, like RSG, like Clean Harbors. So let's talk about waste management. I think the company is incredibly high quality company. It's one of the companies that won't go wrong in any sort of economic environment. But of course, the company is expensive today. It is still trading at 32 times of earnings, growing at around 10% every single year. So I think for a company like this, it is probably a bit too expensive for my liking. So it probably isn't investable right now for me. Next question, it says, check out some China stocks which could be worth investing, BYD. So some Chinese stocks, Alibaba is interesting. The company is trying to remove all its different non-core assets. It is trying to basically concentrate the entire business into just a few portions like your e-commerce, like your cloud and so on. So I think this is the right move by the management. The company is clearly trying to push out the AI narrative and it is executing well. They just had a 26% increase in terms of their cloud revenue just last quarter. So for Alibaba, I think it's an interesting company. It's one that I've been looking at, although the retail portion still scares me. As for other companies in China, I think Pinduoduo is another one that is interesting. Li Lu actually just bought into the company, and as usual, there's Multi as well, which I'm definitely extremely interested in. Just that the margin of safety isn't there yet for me to want to enter into the company. I hope you guys have found this one useful and invest safe.